Hello, good evening, everyone, and welcome to tonight's session, Corporate Connect, organized by SIAS and supported by the SGX Group. This is a regular platform that SIAS runs to connect listed companies with their retail investors. Tonight's session features a REIT, ESR REIT, which is an industrial properties REIT that has investments in Singapore, Japan, and Australia. But before we go into that presentation featuring ESR REIT, we will kick off tonight's session with a presentation by the SGX Group. Jeff Howie, SGX's market strategist, over to you.
Thank you very much, Sivan. Everyone should be able to see my screen. Just a kind reminder, tonight's an educational event designed to provide more information on, of course, ESR REIT. And my intention is just to spend a quick 10 minutes providing a very quick introductory overview. Here in Singapore, as part of our vibrant REIT sector, we have 7 S-REITs that represent the industrial segment, and the majority of the properties are listed with, I guess, the majority of the properties in the portfolio of the entire 7. The majority are in Singapore, followed by some in Japan, United States, Hong Kong, China, and Australia. So there's quite a big, wide global footprint. And this, of course, included in these 7 is ESR REIT, who is our guest tonight. Just looking across the world, Sabana Industrial REIT has all its properties located in Singapore, while Daiwa House Logistics Trust has 97% of its properties in Japan. Maple Trees Logistic Trust would be the most geographically diversified of the 7. It has a little over 20% of its properties in Hong Kong, 20% are in Singapore, 18% China, 15% Japan, and then I think it's 9% for South Korea as of the end of last year. So in industrial REITs, by introduction, they typically invest in warehouses and distribution centers that are essential for storage and logistics operations and so forth. They invest also in some cases manufacturing plants, industrial parks, and these can also house multiple tenants that are engaged in all different type of industrial activities. The data centers are also another key investment for this sector, providing facilities for data storage and processing. Obviously, data centers can be their own segment of REITs as well, if the REITs are 100% or majority focused on data center properties. I think data centers became a actual sub-segment under NAREIT about 5 years ago. It might have been a bit long, 6 years ago now. Business park buildings, high-tech buildings, they can be included in the portfolios, and that obviously caters to technology and also those knowledge-intensive enterprise sectors. And additionally, they also invest in light industrial buildings, stack-up ramp buildings that you see for the light manufacturing assembly activities. So generally, these industrial properties are also typically strategically located to support logistics and manufacturing and tech operations. And overall, the seven REITs have been a little bit more defensive than the broader REIT sector this year. The 7 REITs have averaged a 0.2% year-to-date gain through to the close yesterday, while the iEdge S-REIT index is down 1%. So of the 7 actively traded industrial S-REITs, of these 7 REITs, 6 have reported for the fourth quarter. Daiwa House Logistics Trust will report before the Friday open. All 6 did report positive rental reversions for their portfolios in the latest reporting period that ended in December. And that obviously clearly affirms the managers remain highly active in their lease as well as their asset management. And the positive rental reversion, it boosts revenue, it ups rental income from the properties, and the higher rents can also in turn bump up property values over time. This is because the rental income is obviously key to valuing properties as well. So positive rental reversion has this impact on REITs asset value as well over the long term. But do keep in mind one caveat though, that rental reversion rates, they can vary significantly depending on the period that's being analysed. So you might have a property exhibiting a high rental reversion rate over a longer period, but it has a lower rate reversion over a shorter period. And that means that even if rental reversions are up 20% year over year in a particular quarter, that could have been influenced by leases from being renegotiated from 3 to 5 years ago rather than from that period last year. So that variability, I think, it does highlight that there has to be some importance in considering context and time frame when looking at analysing rental reversions. But as you can see from the table here, I've just taken from all the financial statements from the relevant 6 industrial REITs have that reported, it has actually been pretty impressive. As you can see in the table, Sabana Industrial REIT, it achieved a positive rental reversion of 20.6% for the full year. It's actually had positive rental reversions for 4 consecutive years, in addition to 16 straight quarters of positive rental reversion as well. CapitaLand Ascendas REIT achieved an average rental reversion, as you can see, of 11.6% for its FY24 for its leases that it renewed. And the manager attributed that double-digit reversion to obviously strong demand being a factor, their proactive lease management, positive market conditions, some property enhancements, and of course, importantly, having a diverse tenant mix. So overall, the industrial property market, I think in Singapore, is poised for growth, albeit at a more moderate pace. Strategic focused on managing assets effectively, enhancing portfolios and retaining tenants is obviously clearly important. There is this theme of advancing sustainability efforts as well that's ingrained in these properties now. According to JTC data, the rents for the industrial segment in Singapore rose by 3.5% last year, and that was a decline from close to 9% back in 2023. And that moderation, I guess, reflects a more balanced market this year, as you've got supply of industrial space expected to rise throughout the year. It's 1.2 million square meters of new industrial space is anticipated to be completed. And that could ease some of that upward pressure on rents as well. Overall, the international outlook also remains somewhat cautious. Several factors, obviously. You look at where global interest rates are now. Yes, we've had 100 basis points of cuts since September of last year, but whereas where rates are at the end of this year, it's anticipated that they're going to be 100 basis points higher than what we thought when we started cutting rates in the US in September last year. So obviously, less low is the new outlook for interest rates, and then it obviously impacts financial costs and currency conversions and so forth. Geopolitical conflicts are there, rising costs, and this all always comes back and influences, as we say, key variables, overarching themes like global interest rates, and that therefore does, I guess, necessitate the importance of an ongoing strategic approach to REIT asset management. There is also much focus in the sector on that tenant retention, as I said, and portfolio rejuvenation and sustainable initiatives. Tenant retention, it's a critical aspect of maintaining those stable occupancy rates, ensuring that consistent rental income. And obviously, this is on the managers to build strong relationships with their tenants, understand their requirements, and strive to provide high quality services and facilities and so forth. Portfolio rejuvenation is really important as well. Refers to obviously asset enhancement initiatives can be one form of it. The process of upgrading, modernizing properties to meet current needs and improve competitiveness. The Logis Hub at Clementi, part of CapitaLand Ascendas' REIT portfolio, It's set for redevelopment in the fourth quarter of this year. It's going to transform an existing cargo lift warehouse into a modern 7-story ramp-up logistics property, and that's on the cards. In terms of looking at these type of strategic methods, ESR REIT management, they've been pursuing the 4R strategy, I think since 2022, focusing on recapitalizing the balance sheet, rejuvenating the asset portfolio, recycling capital, and reinforcing the sponsor support. And the CEO of ESR REIT Management, Adrian, he maintains this strategy has led to income growth and is expected to translate into net property income and DPU growth, as well as improved asset and earnings quality. So I'll come to him very soon, but just before, I just wanted to finally also mention sustainability initiatives are becoming increasingly important, as we mentioned before, as the businesses and the investors obviously prioritize their ESG considerations. So these can include energy efficient building practices, renewable energy adoption, other measures to reduce basically your environmental impact on industrial properties. That Lodges Hub at Clementia I mentioned before, it is designed to achieve the BCA Green Mark Gold Plus certification, emphasising a commitment to sustainability. Sabana Industrial REIT's commitment to sustainability was showcased with these rooftop solar panels at 9 of its properties. So it's positioning itself to be one of Singapore's first carbon neutral industrial REITs by 2040. And of course, ESR REIT as well has also implemented a decarbonisation roadmap, which Adrian will likely discuss towards the end of his presentation. So in order to give him enough time to do that, let me finish off here and hand it over to Adrian. Just one more thing before Adrian takes over. This is our Telegram account. If you scan this QR code, you'll see SGX Invest on Telegram. I would guess quite a few of you are already on Telegram, but if you do scan it now, might be surprised. Right at the top of our Telegram account should be a little bit more information on ESR REIT, which is our stock of the week this week on the Telegram account. All right, I'll finish now, and thanks very much. Look forward to catching up with you again soon.
Thanks, Jeff. That was Jeff Howie, market strategist from the SGX. It just occurred to me that it was very remiss of me not to introduce myself at the start. I'm Siva. I'm the moderator for tonight's session, and I represent SIAS, Securities Investors Association of Singapore. Okay, now we move on to the next part of tonight's program, which is a corporate presentation by ESR REIT. ESR REIT is a leading new economy and a future-ready Asia-Pacific S-REIT, listed on SGX since 2006. ESR REIT invests in quality income-producing industrial properties in key gateway markets. As at 31st December last year, ESR REIT holds interests in a diversified portfolio of logistics properties, high-specification industrial properties, business parks, and general industrial properties with total assets of approximately $6 billion. Its portfolio comprises 72 properties, excluding 48 Pandan Road, which is held through a joint venture. 72 properties located across the markets of Singapore, where it has 52 assets, Australia, where it has 18 assets, and Japan with 2 assets, with a total gross floor area of approximately 2.5 million square meters. ESR REIT is also a constituent of the FTSE EPRA Nareit Global Real Estate Index. Okay, with that introduction, I turn the presentation over now to the Chief Executive and Executive Director of ESR REIT, Mr. Adrian Chui. Adrian, over to you.
Yeah, thanks, Siva. Thanks. Good evening, everyone. Adrian here. And also, thanks, Jeff, for giving the background on the overall the JTC situation, what he sees as his strategies, what we fund managers like to do, has been focusing in the last few years. I think my today's presentation, even though the slides are actually mostly, I like to use my full year presentation that we have posted on the website. But I think I would like to focus on a few things is that what we have been doing, as Jeff pointed out, since the end of 2022, when we started what we call the 4R strategy. Give you an update where we are, the 4R strategy, and what you can expect in terms, and with Jeff's Howie's outlook on the industrial sector in terms of supply and all. What does the implication from us? I give a bit of guidances even as well to investors like yourselves and everyone in the market. What do you see? What do we see in 2025 in terms of our earnings? It can be a little bit detailed, but I think it's a useful guide for everyone to look at. So if you look at the our slides itself, quick overview outlook as well as looking ahead. Last year, 2024, our DPU cents is 2.119 cents. We expect this is to be the trough of our year. We have done 2 years of asset 4R strategy, primarily in divesting non-core assets, closing down properties to do rejuvenation. It is now some of the assets, the last 2 years we do rejuvenation, asset enhancement has been ready. They're now all income producing. This trough is expected, and it's a full year impact in 2024 because we divested 534 million of non-core assets. We have $800 million of proceeds from divestments, as well as equity fundraising that we used to reduce debt pending the deployment. And bulk of this money was not deployed in 2024 and 2023 and 2024 because of rising interest rate environment. But at the same time, while we were able to use the proceeds in the short term to reduce debt, we were also waiting for opportunities to come up because we expect the high interest rate environment to be driving cap rates, which will impact cap values. So we bided our time to make sure that we were finding the right opportunities, that even while we expect we have divested our non-core assets, whenever we recycle, we need to recycle them back into better quality assets, especially if you know for Singapore industrial assets, land leases are very short. And for industrial sector, I will share with you is that rejuvenation of assets are important is because we need to have our assets relevant, and to be relevant, you need to, and with technology changes, manufacturing technology changes and user changes, you need to keep your assets fresh. And that is why you see a lot of industrial companies doing asset enhancements, industrial REITs doing asset enhancements, as well as redevelopments, primarily because of this reason. And at the same time, the distribution as well is now 2.991, apart from the divestments of the non-core asset as not recycling yet. We also decommissioned 2 fishery port in preparation for a redevelopment again. And also, but in 2024, the good thing is that we actually have redeployed the money, bulk of the money, 775 million, into 2 pro forma DPU accretive acquisitions that is in Singapore as well as in Japan, called Yatomi Kisosaki DC, as well as 20 Tuas South Avenue 4. As you see from our circular that we had in the shareholders meeting in September, both transactions are acquired at a discount to valuation of 2.3%, and at the same time, it is going to give a 3% pro forma accretion, DPU accretion. Now, as a result of our 4R strategy, we have seen our portfolio and earnings quality improved. And we expect this acquisitions as well as the AEIs and redevelopments that we have undertaken the last 2 years, who have now been completed and started the contribution. They will contribute meaningfully to our P&L, which I will go onto the next stage, next few slides. But currently, if you just look at the asset quality itself, we have lengthened the land leases. We used to be 37.4. Today, we have gone up to 44 years underlying land leases. The amount of freehold assets and more than 30 years land lease have increased from 54% to 71.6%. The percentage of new economy assets has actually gone up to close to 70%. Now, how does this then, all this 4R strategy that we've done in the last 2 years, translate into going forward in 2025 and even 2026? If you look at this slide, this is what we have been guiding our investors as well as analysts. We expect the revenue to increase over the next going into 2025, and at the same time, we are able to manage our operating expenses. So we expect overall the MPI to increase due to the full year contributions from all the initiatives that we have undertaken in terms of completed acquisitions, AEIs, as well as positive rental reversions. Now, if you look at line by line item P&L, you would see on the green box on the left-hand side. We expect rental contribution to increase. Why? Because the acquisitions which we completed in December 2024, which is only gives us about 1 to 1.5 months of income contribution, is going to give a full year income contribution to 2025 revenue numbers. Our key focus in 2025 is going to be on core operations, as well as to demonstrate our MPI as well as DP uptrend is going to come in. We have all initiatives that's taken over the last 2 years. You are also going to, apart from acquisitions, we will also have full year contributions from the completed AEIs. As some of you will have remembered, we have 2 AEIs that is actually completed in 21 Senoko Loop as well as 7002 Ang Mo Kio. These ones have achieved the TOPs and they will start to give contribution full year in 2025. At the same time, 2025 onwards. At the same time, last year, as you've seen, Howie has also mentioned, we have positive rental reversions coming in our portfolio in 2024 of 10.3%. This again will continue to provide income contributions to the top line. Now, then you come to the expenses, like operating expenses line. 2 biggest items that we are always very aware of is utilities expense as well as repairs and maintenance. For utilities expense, 90% of our portfolio is on a pass-through basis. That means whatever we buy from SingPower, we charge the same to the tenants. We don't earn any spread. So if the power utilities cost goes down, we don't gain. But if the power utilities surges up, like in the year when Russia war broke out, we don't get a big dip in the hole as well. And we expect this year, probably the utilities rates to remain similar, but it's not going to affect us, as I said, because 90% of the cost is being passed through to the tenants. Now, what about the 10%, you may ask? We are in the midst of rolling out our solar systems over the next 2 years, and this is then expected to bring down the utilities expenses, but it takes time to install because solar panels just don't generate this. It's not installed overnight. So we expect utilities do not affect us because it's mostly 90% on a pass-through basis. Now, repairs and maintenance, we actually expect repairs and maintenance costs to go up because labor cost is going up, progressive wage model, and also the general inflation on raw materials. Primarily, if you look at labor costs, security contracts, so it's cleaning contracts, these are the ones that subject. We expect this cost to go up by close to 20%. Now, it sounds a daunting number, but if you recall, in September 2024, we've also announced an increase in service charge, close to about 65% of our REIT portfolio. And this increase in service charges is expected to offset the increases in repairs and maintenance. So in short, we expect the net property income, or NPI in short, to still be trending upwards going into 2025. Now, after you look at the third biggest item on the P&L, before you come down to distributable income, will be interest costs. Now, what do we expect? I mean, Jeff has given earlier things to say that interest costs, after the 100 basis point cut, it is expected to stay elevated. I think there are a lot of literature that the Trump tariff policy is inflation inducing. The numbers are starting to show even in the US in terms of the core inflation and all. But from our perspective, when we look at ourselves, our interest was how we manage our debt expiry profile, our hedging policies, and our hedging strategies. We expect that our cost of debt, that is ESR REIT's cost of debt, to be lower going into 2025. Our peak was in June 2024 at 4.03%. As of 31st December, it has come down to 3.84% because we were able to take the opportunities when interest rate got cut for 100 basis points to actually hedge more at a lower interest cost. So as of 31st December, 3.84% was the interest cost. It came from a few things: early refinancing of our 2025 debt when the interest rate when there were 2 or 3 rate cuts in the fourth quarter of last year. We took advantage of that to refinance our 2025 debt. When we acquired the 2 large assets of Kisosaki as well as 20 Tuas South, we actually use it as an advantage to large assets and good quality to get cheaper margins on existing loans. We refinance some of the existing loans as well. Take the opportunity to do a big deal with the banks to say, okay, you don't only going to finance me on these two new assets, you are also going to refinance some of existing loans, and we package all together and use it to advantage using economies of scale, and that resulted in cheaper rates. And also our hedges, which were expiring, and that we painstakingly manage it over the last 2 years to make sure that it can expire at the right time. We were able to refinance those existing portfolio hedges at the lower rates in 4Q because of rate cuts. Now, we expect this lower interest cost of our portfolio to continue going into 2025. Why? Why do we say that? Because we expect the interest savings that we have refinanced expiring debt in 2025 to lower interest rates to come in this year, because it's refinanced at least at a 15 bips lower margins. Now, we are now working on refinancing 2026 debts at potentially lower margins. Why? It's because our portfolio, as I mentioned, the quality, the previous slide has shown you that yes, quality of the portfolio has gone up. The earnings quality has also gone up. So because of that, we believe our credit quality of the portfolio becomes better. So we should expect lower margins when we refinance 2026 debt. And the important part for us is that all our loans, we do not have prepayment penalties. I mean, in a layman's term, when you refinance your housing loan early, or prepay your your loans early, generally the banks will charge you a prepayment penalty. For us, we don't have it. So we will enjoy the full interest cost savings for our refinancing of a 2026 debt. And we are also continue to be able to expect the refinancing of our hedges at the lower rates. For example, just recently, when we saw that the SORA came down, SORA had been pretty high. 3 months, SORA had been pretty high. In the first, since Trump became president, it was at 2.8, high 2.8, 2.9%. But last week or 2 weeks ago, we saw the SORA came down to 2.5%, and we took the opportunity to went in to hedge it at 2.5%, which is much, much lower than what we have budgeted and expect the hedges to be. We were expecting SORA to trend in the year to be 2.7%, but we managed to, we ended up seeing 2.5%, so we were able to do that. The last one, in terms of interest cost savings, we think that we have still a lower coupon. We still have 75 million of quite an expensive PERP that was coming at 6.62%. We believe that this year we could refinance it. Either we use it from divestment proceeds, or we could refinance the PERPs at a lower coupon for reviewing a new PERPs. So all in all, you will see that for interest costs, we expect it to be lower by early refinancing of a 2026 expiring debt, refinancing of hedges at lower rates, as well as potential redemption or exchange of the more expensive PERPs that's outstanding. And if you look at overall the cost expiry profile, the cost of debt has come down to 3.84. All these three things add together, we are guiding the analysts that the interest costs could reduce by another 15 to 20 basis points to about 3.6 to 3.64% by the end of 2025. So that's why we expect the interest cost to still be able to come down. At the same time, our debt expiry profile has also lengthened to 2.8 years. So if interest rate stays, and at the same time fixed rate exposure is 75%, we expect to go towards the end of this year towards in the region of about 80% hedge, 80% hedge fixed on a fixed rate basis. And our MBS adjusted ICR is strong. So if Jeff is correct, the interest rate will still stay elevated. I have no doubts. I think he may be right. Interest rate continue to stay at where it is right now. I think our debt expiry profile, where it's lengthened, has higher fixed rate exposure, is going to help us quite a fair bit, at least to get by the high interest rate environment. If you go to the next slide, this is just the 24 results. As I said, this is expected to be the trough. Even though revenue, the net property income is down 4.4% year on year, we expect this to be the trough because the income contribution of the new acquisitions, all initiatives will start to come in. And I would say that this year, we have divested quite a fair bit of properties, 564 over the last 2 years. This year, we probably won't divest so much, but there are still some assets that are non-core. They're old, they're smallish. It doesn't make sense for us to hold on. Land leases are short. We are probably targeting about $200 million of divestments this year of really non-core assets. We are half of it, of the 200 million, we're in the discussions with in exclusive discussions with parties, and it will probably take time. And we expect probably these divestments to be at least book value, if not higher than book value. I won't mention, capital management I've gone through. So if you look, this waterfall chart is essentially showing a very quick snapshot summary of what I just mentioned. Those on the left-hand side is exactly the 4R strategy that we're done. We lost income because we divested properties to region the portfolio. We have some dilution because we reinforced our balance sheet back in 2023 with a fundraising before the interest rate environment rised as well. So this has been done all on the left-hand side, is what you will see has flow into the numbers. But those on the left-hand side is what you see going forward into 2025 that will give you full 12-month income contribution, because the NPIs from completed AEIs as well as net contributions from acquisitions will start to give a 12 months income contribution. So if I bring you to slide 17, just to touch on a little bit. I won't bore you with the results. You can see that slide 17. You will see that then going forward, what is the outlook that we see? The rental reversion, maybe I go to, if you see this slide, there are going to be expiries 2027, 2025, 2026, 2027 expiries that we are coming back. And we think that there will still be organic growth that is driving. And the bulk of the leases was going to come from logistics as well as high specs, which in the next slide, I will guide you again what we think is the rental reversions. If you look at 2024, the rental reversions of 10.3% across the portfolio actually comes from two of what we call new economy asset sector, high specs industrial as well as logistics. Now, we are of the view, and I've been guiding analysts, and Jeff has also mentioned, he showed you in the slide earlier, the JTC rental index has come down from 8.3 to 3.4%, and there is supply coming in. So this will dampen the rental reversions, but we still expect the portfolio rental reversion going to 2025 for our portfolio still to be positive, but we are not likely to see double-digit rental reversions. You look at my slide, 10.3% was 2024 rental reversion, 2023 was 11.1%, 2022 was actually 11.4%. So we still expect in 2025, which we have been guiding the market, that rental reversion will still be positive, but it will likely be probably in the region of about 5 to 7%. Okay? Portfolio 5 to 7% rental reversions. Why? You may ask why. Well, supply is one thing. And the second thing is, all the lower rentals that were signed during the COVID years in 2022 and 2023, 2021, 2022 has been marked to market today. So that so-called low base effect has actually been gone. So what you're now going forward is already marked to market real growth rental reversions. We expect our portfolio ending up 2025 to be at 5 to 7%. Logistics and high specs will still be the major contributors of rental reversion. We expect it to be 6 to 7%, both logistics and high specs. Well, half, you may say, wow, half of what you have delivered in 2024, but it is still in a positive territory of 6 to 7%. And this time is based on mark-to-market rental, 6 to 7% of what you have, what the existing rent expiring leases would be when it was mark-to-market 2 years ago. General industries, we think that it will still be about 5 to 6%, tracking the whole portfolio itself. But business park is where we believe, and we've been guiding the market, that for our portfolio, probably be flat for us. That is what we think. We don't have a large business park component. We only have 2 business parks. One is in Chai Chee and one is in Changi Business Park. And for the Changi Business Park, our location is right in the center of Changi Business Park, where the MRT is right below. So even though business park is flat, our component of business park is very small. Logistics and high specs makes up about 75% of our portfolio. So these are the ones that will still bring in the positive rental reversion of 6 to 7%. So if you add the remaining 25%, which is business park as well as general industrial, then you will probably find that come up with what our rental reversions of a portfolio probably in the region of 5 to 7%. And if you go to slide 24 and 25, I talked a little bit about our divestments. Last year we divested things, so we're targeting 200 million non-core divestments in 2025. Continue our portfolio rejuvenation strategy. We believe that the 200 million it should be at least at book value, if not higher itself. And then if you look at slide 25, two of the assets are completed. 21B Syndicate Road 7002 was completed in end of 2023. Then the occupancy was about 60%. It has gone up gradually in 2024 to about 78%. We expect we only have one more floor left at the top floor. We expect this year probably 2Q to be 100% for 7000 Ang Mo Kio, and that will contribute full 12 months of income into 100% occupied building, providing a full 12 months income to again the bottom line. The only 16 Tai Seng is in progress. We expect this to be end 1Q, maybe early 2Q to be completed. That it will start contributing income. We are now working out on the planning for the Two Fishery Port, do a redevelopment of Two Fishery Port, and we will announce it when we are ready in terms of the financials itself, the numbers. So if you look at slide 27, I think this is on the rates itself. I'm not going to go through that, but if you look at it, you can expect, even though its fixed interest rate is about 75%, with a fixed exposure of 2 years, we do believe that we will be hedging it more, and we are probably comfortable with our 80% fixed interest rates hedging itself. And I think if you look at the conclusion of where we are on slide number 40, I think overall for us, we have executed the 4R strategy over the last 2 years. The fruits of this 4R strategy is now going to come in, and it goes into 2025 itself. Our portfolio and earnings quality has actually increased itself. We expect positive rental reversions to still continue. Our assets are newer, longer underlying land leases, and more relevance itself. These two acquisitions have definitely improved our portfolio overall. And in terms of outlook for 2025, based on what I've run through with you, we expect MPI and distributed income to increase given the meaningful full contributions from the completed acquisitions, completed AEIs, developments, as well as positive rental reversions. I think our debt is quite managed in terms of costs expected to come down a little bit, and at the same time lengthen it out. So if interest rates continue to stay high in the next 2 to 3 years, I think we should be able to skirt that high interest rate environment. And if shareholders, investors, if you recall, there were some REITs who were really decimated by the high interest rate environment. And even till today, if you see some of the results, there were REITs whereby the interest rate has gone up so high that even their rentals are not able to cover the interest costs, and that is why they can't even pay distributions. I don't think we will be there. I think we've managed that very well. We have skirted the high interest rate environment in the last 2 years itself. We think that over the next 2 years, we can manage that, even if interest rate stays high. Our focus really in 2025 is to ensure that the earnings and the NOI and DI flows through and get reported out so that you guys can see the real impact of the numbers that we have, the rise in the NOI as well as distributed income that we have managed to part of our 4R strategy. We will actually start to monitor the tenants' businesses. Market is volatile. You have all the Trump's thinking going around. It will affect tariffs and all. We will monitor tenant businesses. I can assure you that we are not seeing tenants coming to us to tell us that I want to return space. No, I don't think we are seeing that. But the mood is more cautious. People are taking time to monitor the situation. In fact, I can share with you that we have been getting a lot of queries with regards to space for logistics as well as advanced manufacturing. Now, we're getting queries, but I'll be honest with you that we have yet to see it translate into actuals. It is probably expected. It's because where Trump is going right now, a lot of MNCs are preparing. If he goes through with his Paris plans on China and the global resupply chain need to re-op, they need to the MNCs need to relocate their global supply chain, and that is why they're asking for queries. So I would say that we are seeing more, we're getting entertaining more questions, but whether it will get converted into spaces is yet to be seen, and we probably won't see it won't get an outcome probably for at least another quarter. Obviously, the last part that we'll focus on this year will also be managing interest costs. Interest costs, as how we say, very likely to stay above high. And that is important because we have learned, and we have not learned, we have seen other REITs good work that is done over the last 2 to 3 years. Just for one time interest rate goes up by 50 bips, wipes out all the good work that you have done. So that's where we monitor interest costs, so as to ensure that overall, our income is stable, earnings quality is going up, and whenever there's opportunities for us to lower interest costs by fixed rate hedges, we will do that. So with this, Siva, I end my presentation. I hand it back to you.
Thanks very much, Adrian, for that insightful presentation. We turn now, ladies and gentlemen, to the Q&A session. There were pre-submitted questions, and so far there have been quite a few questions submitted through the webinar chat. I think it's only fair that we try to answer the pre-submitted ones first, but there is one pre-submitted one which is similar to one that has been just submitted through the chat, oh, sorry, my video is off. Okay, sorry. Okay. There's one question which is similar, which relates to the 10-to-1 consolidation. Okay, so the pre-submitted question asked, will the consolidation cause a further drop in the share price since the market sentiment for S-REITs is not so favorable due to the slowing in the pace of US interest rate cuts? And the one that was submitted by Tan Han Kiat basically asks whether you have any knowledge of short selling activity. I think this one is a bit difficult, but because apparently that was mentioned in your SGX announcement about short sellers.
Yes, let me share with you that. I mean, the short seller was the result of it. But what we are noticing is when we see a lot of excessive share price volatilities. The reason is what we see is that when where the share price is a bit lower, the change in a 0.5 cent change from a percentage point fluctuation is big. So a 0.5 cent change in our numbers means a 2% change. A 1 cent means 4%. Now compared to if the share price is more like a $1, that 1 cent is a little bit different. So if the market moves 1%, right, and we have to follow that, and 1 cent we also move, then it pays to the 4%. Now this what we call the basis point spread essentially gives rise to arbitrage traders who comes in and play with your stock. They just do huge volumes by doing a short selling, and nowadays with program trading it is even faster. So by doing the consolidation itself, it makes it more expensive for would-be, I would say, lack of a better word, punters to try to punt and play that game as well. So that is why we've seen, and we studied the kind of fair bit. And if you guys notice, those who have Bloomberg or even just use Yahoo Finance, we start to notice that we can be up 1 cent, 0.5 cent, 2 to 4% a day throughout the day. At the end of the last trade, it gets pushed back down to flat. And this is exactly what we see as program trading. And this feedback is not just what we notice. Some of the institutional investors are telling us they are program traders, punters and hedgers who play the stock. So they're just playing the arbitrage game. They totally ignore, it's a short-term gains. They go by volume and they totally ignore what are the fundamentals. From our perspective, We know going into 2025, as I explained to you, what is going to come in from the P&L line. Distributable income, MPI expected to go up because of these distributions. We don't want these people who don't care about all these fundamentals to try to play around with all this. So that is why we think that it's very beneficial to the unit holders to actually do a share consolidation, because the whole intention is to reduce the share price volatility from that so-called bid-ask spread. And that is the whole purpose of that. Yeah.
Okay. Okay, thank you. Thanks for that, Adrian. I'll have a look at the questions. There's one question from Daryl about overall debt strategy. I think that's already been answered.
Yes.
All right, the perpetual bonds and so forth.
Yes.
Okay, that's done. ESR has touted previous M&A initiatives as transformational and accretive. What happened next was a drastic decline in DPU, NTA, and share price. Why would this new transformation program be different?
No, of course.
Lee Weng Fu.
Sure. I think it's quite straightforward itself, right? When we did do M&A initiatives, we were able, there was a certain intention of why we need to do that. We were small. Our debt cost during that margin was like 2.5%. Today, we are much bigger. We have the size. Debt cost is coming down. But at the same time, when we look at the M&A activities and our portfolio we add together, there are assets that were non-core. You have good assets. You also do have come as a package. You do have assets that were not relevant at all. And M&A, you can't pick and choose. But the key was then is that to make sure that the M&A puts us on a bigger footing, that we were able to undertake all these rejuvenation exercises, redevelopment, such that if we close down a building, the impact is not as big. Now, the question then would be, why do you then buy those assets that you don't want? Well, the answer is when you come to M&A, you come in with a package. And you can't just pick and choose. If you could pick and choose, the other side will not want to sell. But we have achieved our objectives that we are now a mid-cap stock. I can share with you, 6-7 years ago, before we were this size, even you want to lease out a property, a vacant space, your listing will never be on the front cover of the listing agent, okay? Because you don't have enough space. You don't have enough choices for the agents, brokers who want to go out and lease. Today, we have. You look at 7,000 Ang Mo Kio. It was clear. Before at TOP, we already 62%. Within 1 year, we are going to get to 100%. It just basically shows, because you have the cloud. When you are large, people pay more attention to you. When you're small, I think people tend to say, I can bypass it. And the second part of the strategy was the last year is what we did. We need to clean up the house, not clean the house. We need to basically take away, and we are facing assets that are actually 20, 30 years old. Underlying land leases have left 20 years, some are 15 years. You don't do anything, you stick to that. You just want to hold your DPU. Eventually, your NTA will come down. That is why we took the strategy, and we communicate to people. There are some people who say, guys, I don't believe you. I'm not going to wait here, because if I sell assets, you sell assets, and all this stuff, DPU will drop, NTA will drop, of course, because you have no income. You close down buildings. But your asset quality and your earnings quality, if you don't do anything, that's the problem, because Singapore assets are by nature short land leases. So I do think that the strategy, and if you see my presentation just now, what we are able to do, and because of the M&A strategy, we are bigger, we were able to spread out our debt expiry profile, our hedging expiry profile. We could close down 2 buildings, actually 3 buildings 2 years ago, and not have a big drastic drop in DPU. And when we did, subsequently, we added on our 4R strategy, we were able to avoid the high interest rate environment that killed a lot of people, okay? In 2023 and 2024. Some of that, as I mentioned, they are still feeling it, because the interest rate environment, the interest cost has gone up so high that even their rentals cannot pay off their interest costs. And that's why they have to suspend distributions. I think memories can be quite short. People don't remember that in 2020-24, interest rate gone up from 0.25% all the way to 5.25%. Okay, I think memories are short. But essentially we avoided that. I don't say that we saved the REIT, but we make sure that we were there. And now the fruits of our labor that we're going to do the last 2 years, where we rejuvenated, have better asset quality, earnings quarterly are going to come in. Yeah.
Okay. Thanks for that, Adrian. Speaking of asset quality, Ngo Chi Kyong has asked, your NAV has continually declined over the past few years. Is the NAV expected to continue reducing in this year and next?
Well, NAV will go down because we sell assets. Once you sell assets, you basically don't have valuation, right? But if you look at it, we have reinvested those assets into freehold as well as leasehold. The problem with Singapore industrial assets is that land lease is 30 years. That also means that every year we have called a land lease decay. Now, if you just do a simple mathematics, 1 divided by 25, it means that every year, 4%, you will lose value on the asset value by 4%. If your rental reversion is high enough, then maybe you can make up for the drop in land leases. But you will always every year start to face your 4% because of valuation drop, which impact your NAV because of that. By redeploying our assets into freehold and much longer leasehold, you don't have an issue. At least the freehold assets you don't suffer the land lease decay problem. So we believe that the assets, as well as we have, at least it doesn't reduce any, it doesn't have any land lease decay issue. Yeah.
Okay. All right. Most unit holders will always ask about dividends. So Hanley has asked, can you provide any guidance on the company's dividend policy? And how do you plan to improve dividend payments in the future?
Dividend policy, dividend is you pay out 100%. Yeah. So are you asking a policy or asking you what's
I suppose they're asking, well, no, okay, this is related to an earlier question by Han Kiat. With the projected 15 to 20 basis points reduction in your weighted cost of debt across the different debt instruments, what is the expected contribution to FY25 DPU in terms of percentage?
I don't have it off my... Charlene, do you have that number?
No.
I can come back to you on this. I
can't. You can post that on your website later.
Yeah, I can post it. I can post it. Not issue. Hankep, I can post it. Fair question. Yeah.
Okay. Lee Weng Fu has asked, how would the Johor Singapore Free Trade Area impact demand for logistic assets in Singapore?
Well, to be honest, I think that is a big mega project. I don't want to sound like a snobbish Singaporean, but I think it is to see how it pans out. Today, I think Malaysia already have an area for all these industrialists who wants to go there to do the work, which essentially is called Iskandar. It's still there. People could go in. And I think it also depends on what does the Johor SEZ or whatever call that, what are they targeting? If you're targeting so-called middle manufacturing, I think it makes sense there. I said because land costs, construction costs, labor costs is probably much lower. But if you want to go on but you already have that because, as I said, Iskandar is already there, right? You can do that. But if you want to look at high value manufacturing, I think there are a lot more factors that you need to take into consideration. High value manufacturing, you have to do number one, your air and seaport, because you need to bring components in. You need to retrofit, manufacture, boom, you need to go out. So your air and seaport will become important. So you need to have the infrastructure. Number two, you need to have talents. You need to have people. I talk to my many Malaysian friends who are here or PRs or is converted to citizen. They tell me that we love to go back to Johor, but we want the life and the working hours there, but we want to be paid in Singapore dollars. So that will then become a cost issue. Then once your cost becomes that, then will that be competitive? So, but I think in short, I think there will be an impact. Don't get me wrong. But I really don't know right now what is that positioning in terms of what is that? Is it targeting high value? If you target high value, it's just high value manufacturing. It's not just cost. It has other implications like talent, attracting back the talent, the workforce. the airports, the seaport, the connectivities, and all this. So there is an ecosystem to that. So at this moment, I think it's still too early for us to say. The only thing we can do as far as our REIT, ESR REIT, is that we're going to make sure that our asset stays relevant. We continue to where assets that we can enhance, we enhance. Those assets that we can't enhance and it's too small, we just sell it off and try to get the best possible price, at least book value, if not a premium to book value.
Okay. All right. Terence Ngui has a question. Do you plan to invest in other countries besides Japan and Singapore? And this one is the second part of his question was also asked by others. Any plans for more equity fundraising to expand your
I think we will focus on these three first part, Terence, first part is that yes, we will focus on Japan, Singapore, and Australia that we have. Okay. I think first thing, when you want to go to a country, you don't expand for the sake of expanding. We leverage on the ESR groups when it comes to overseas properties acquisitions. These three countries, Japan, Australia, and Singapore, has full-fledged real estate team that is there. They can manage our assets well. They know the market well. So we will stay. And I can extend a little bit more to the question, Terence, is that if you are asking me about what about China, I'm telling you no China. Okay, we're not going to China. Okay, I need to say this because usually a lot of people think that, oh, ESR Group have assets in China, they will sell. No. We won't go into China. The second part is on the EFR. I guess, as I mentioned just now in my presentation, my focus on 2025 is on making sure that what I presented on the slides earlier on the revenue contribution, the MPI, and distributable income going up is what I'm going to focus on. I'm also going to focus on making sure that my tenants are there and managing interest costs. This is my focus. Acquisitions wise and all this stuff, that is not my focus. Okay, yeah, that's what I can say.
Okay. All right. KH has asked, how much did the 800 million in divestments reduce the NPI by?
The 800 million, we divested at probably at the average about, I would say 6.5% to 7%, anywhere between that. Yeah. And the acquisitions that we bought is probably about 6 to 6, and initial yield is 6 to 6.5 there. So if you wanted for a dollar for dollar replacement, it won't be, and it has to be that because you are divesting assets at argument 6-7% is because the land leases are short, so the prices cannot reflect the prices to reflect that its land leases are short. When you buy something that is freehold and leasehold, you are not going to be able to be buying at 7% basically you can't be buying freehold asset or longer leasehold asset at the price of a 30-year leasehold asset. Essentially, that's what I'm trying to say. Yeah, but that's only the initial yield. For us, the important part is then how do we manage it to make sure that it goes back. We can do proper rental reversions, and then these underlying assets do not lose the NAV. So DPU is one thing. The other one is also NAV. It's always a balance between these two. Because if you want good DPU, go and buy short-term leases. Then short-term land lease assets, you can give you 10%, but the underlying land lease is only left 15 years, 20 years. Okay? But if you want to have NAV, manage NAV, then you have to make sure that the underlying land leases are not 20, 30 years. But that also means that the yield will be lower. It's just like us. You don't expect to be buying a freehold property at the price of a 99-year condo. That is the same concept.
Okay, we have a limited time left. I think just one last question, which was a pre-submitted question. How do you differentiate yourself from other similar REITs? Now, what is your unique selling point?
I think for us, we will focus on our core strength of the group, which is essentially logistics. Okay. I do notice that there is a question by Mr. Hong Yap, is it? Sorry, if I pronounce you correctly, apologize for that. Is there any plan to go into data centers? My sponsor has been building up data centers the last few years. It is a possibility. Today, Hong Yap, I already have data centers. Okay, but my data center is in my high spec space. 7,000 Ang Mo Kio. The anchor tenant is a data center operator. I have in Chai Chi, my business partner Chai Chi, another data center operator. So we have that. But I think our focus will still, my focus, that's why I say our focus is new economy. New economy assets essentially means high specs as well as logistics. Our DNA, our birth of ESR Group as a whole is actually logistics. So I like to focus on that. Now, however, data centers right now, it doesn't make any sense. The people are buying data center at crazy prices, at 2-3% MPI yield. I cannot afford it. It will be dilutive if I buy it right now. So the answer is we will look at data centers, but is whether we'll go inside or not, that's a separate question altogether. But am I going to go after data center tenants to fill up my high spec space? Yes, my answer is yes. I will do that because I know these guys can pay rentals. Yeah.
Okay. We've reached the end, guys. It's 8 o'clock. I think for those questions, we've managed to answer quite a bit. 10, I think 12 questions. For the remaining questions that haven't been answered, I think ESR will take them on board and try to answer them on their website later on.
Yes.
So
we'll do
don't
that.
worry, guys. If your question wasn't answered, it will be answered in due course. And okay, that brings us to the end of the session tonight. Remains for me to thank Adrian for his
Thank you
time,
very much.
SGX's Jeff Howie for his expertise and his presentation. And for me to just remind everyone, this is a bi-weekly webinar, so please visit our website, SIAS website, to get updates on upcoming educational programs and initiatives. Our next Corporate Connect is taking place next month, featuring Innotech Limited. And if there are any companies that you would like to see featured, please type in the chat box for and give the suggestions to us. And that's it for tonight. I'll wrap up. Thank you very much for coming. And once again, good night and happy investing.
Thank you very much. Thanks, Eva. Thanks, everyone.
Thanks, Adrian.
Thanks.
Bye. Good night.